Welcome to More Living with Jim Brogan, your source of information for living the best years of your life your way. For more than a decade, host Jim Brogan and his expert guests have come together each week to share important news and advice that can impact the lives and well-being of those who are retired and those nearing retirement. Learn about issues like health and fitness, financial planning, Social Security benefits, investment advice, and more. And now, here's the host of More Living, Jim Brogan.
Good morning, East Tennessee, and welcome to More Living with Jim Brogan, where it's all about living the best years of your life your way. This is News Talk 98.7 WOKI. The sun is out this morning. It's a little chilly, but thankfully the sun is out. And it did come out this morning in spite of one of the worst weeks in stock market history. We had one of the fastest market corrections in stock market history, and it's, of course, been driven by fears of the coronavirus. So we're going to talk today on the show about what's been going on, how do we explain what happened this week in the markets, and how it may have affected your money, and what do you need to be doing moving forward? And what's the difference in how you handle an investments versus developing an actual financial plan, and how that helps with all of this? But first, let's just kind of review everything that's been going on. Of course, the whole week, the market did experience one of the fastest corrections in U.S. history, and certainly the outbreak and uncertainty of the coronavirus, to me, is the cause. Now, I do think there's something to the fact that markets have been at all-time highs, and I think a lot of investors are jittery. You know, how long can the bull market run? And so, when the sell-off started happening, I think it kind of snowballed a little bit, and then it just kind of fed into itself. So I think there was a little bit of that in there. I think, but mostly this is just tremendous fears over this coronavirus. And then we had the recent outbreaks in Japan, South Korea, and Italy. Then the concern that was this one person in California last Friday, a week ago, that, didn't seem to have any connection to any travel or anybody that had traveled from Asia. And so, everything just kind of fed into itself. And the reason is it's all about how this could affect the markets. How will this affect economic activity down the road? There's been a shutdown of manufacturing in China. They're just now starting to pick that back up. Numbers of new cases in China have gone down. There's some concern of some health officials that they'll start picking back up again now that they're trying to, start production again. I mean, schools in Japan are closed for several weeks. So, services will get suspended. Certainly, there's been implications with Starbucks and Apple, just fundamental U.S. companies that are affected in Asia by the outbreak. And so, and we get a lot of our supply chain comes from China and from that region of the world. And so that could then, turn and have economic impact on us here. And how does it affect U.S. companies and their corporate earnings? So what do we make of all this? Personally, I think that there has been a good bit of panic in the market sell-off that we've seen this week, and I think that it's been rampant short-term speculation that has driven the markets. Now, don't get me wrong. Don't misunderstand me. I'm not saying that there aren't legitimate concerns of what the spread of coronavirus will do to economic activity. What will happen to economic growth here in the United States? What will happen to economic growth around the world? So those are legitimate concerns. But what has happened this week is rampant short-term speculation, in my opinion, that definitely has panic in it, in my view. But in reality, the true impact of this coronavirus and what it does economically, and therefore to our stock market, may not be realized for as many as 6 months or 9 months or maybe even 12 months. I mean, we're way downstream of how this may actually affect economic activity, which is really what drives markets. So what we saw this week was this rampant concern of, oh my gosh, what is this going to do to profitability around the world and in the United States? And it's pure speculation and probably a little bit of panic, as I mentioned. So to me, trying to predict the final outcome is a fool's errand. You know, it's very important to remember that this issue with coronavirus is temporary. Now, granted, we don't know how long it will last or how deeply it will affect us, but it is temporary. And then life will go back to normal. Okay, and I'm not trying to be insensitive there. You know, and there's been a lot of discussion. How similar is this to the actual flu and how many people the flu has killed this year in the United States? I'm not going to get into all of that. And I'm just trying to explain to you what has happened, what are the implications, and what do you need to be doing moving forward. But I think it's far too early to predict and assess its impact on economic activity and corporate earnings. So that's where building a financial plan is essential, knowing that the reality of these types of market conditions can happen and they do happen. We need to plan for this kind of volatility before it happens. Now, we're already in it, so what do we need to be doing? I'm going to cover that on this show. But there are several planning factors that influence all this. You know, how diversified is your portfolio? How much are you invested and correlated to just the stock market? How much balance do you have of other asset classes that don't just move up and down with the stock market? You know, so you got a whole bunch of things that when one thing zigs, another zags. You know, certainly the more aggressive you want to be in the longer time of your time horizon, like if you're 35 years old, you know, you really shouldn't be worrying too much about this unless it were to affect your job. I mean, you should be investing as much as you can while markets are down. As you get closer to retirement, diversification and stability of the portfolio becomes much, much more important. And then understanding that short-term money needs, short-term needs for cash or for income, should not be coming from market investments. And that is a fundamental tenet of wealth management. And that's where I think people are getting into, you know, could get into some trouble now. Oh, what do I do, Jim? I need to take income next month and all my investments are down 10%. You know, that becomes a challenge. What if it becomes 20 or 30 or 35%? And then you're compounding your losses because you're selling those investments and spending the money. You know, it's okay to sell something when it's down and reinvest it, but you don't ever want to sell it and spend it. So your shorter term needs should be really, that money should already be protected. And I'm going to get into more of that when we talk about financial planning. And then you should, you know, probably have the other thing that safe, stable investments do is they offer hedges for down markets in times like these. And as you need more stability in a portfolio, as you get closer to needing retirement income, that becomes more and more important. So the principle of creating a financial plan based on when you'll need the money and what you need the money to accomplish for you becomes critically important. But, you know, fear makes people do irrational things. And I think there's been a good bit of fear this week. I mean, you know, when I turn on the news, I mean, it can be scary. And then you have to cipher through that. I mean, there's a lot of politicalization in our news, even with this health outbreak, as we've seen. We're in a presidential election year. And so, you know, there's a lot of sensationalism. How do we sort through all that? Well, I think ultimately, you know, where investors make mistakes is when they when they have short-term reactions to what should be a longer-term focus. All right. So, you know, when we have the right financial plan, the short-term volatility of the market really shouldn't have a big impact on us, as long as we've structured our investments properly. So we're focused on a longer-term result, and then we shouldn't get sidetracked by the shorter-term focus and reactions. So that's where people can get sideways. The problem I see is that, you know, most people I talk to, most people that come to my class, most people that probably listen to this show don't have a financial plan, really. You may have an investment plan, but you don't really have a financial plan. And so you don't know how to react to this because number one, you don't have a plan. And then number two, it's critically important that at least from a 30,000-foot view, you understand the mechanics of your plan. Like, why is it put together the way that it is? Because then you're not likely to panic. And investors make so many mistakes when they panic. I should have pulled a study. There was a study that was done. It was a couple of years ago. And I should have it in front of me. And I'm just going to give you generalizations. But it had looked like at the last 30 years in the stock market. Or actually, no, it was 20 years. In the last 20 years in the stock market, the market had averaged close to a 9% per year return. But the average that was like the S&P 500, the total return of the S&P 500, U.S. stocks. The average investor had made between 2 and 3% per year. And the reason for that, the number one reason, is making behavioral mistakes. Panic, fear, greed, all of the above. All right? Now, I'm not telling you to do nothing right now. I'm just telling you that a good financial plan will address all this. And then when we're in the midst of all this, if you don't have a comprehensive financial plan, then you need, to be very calculated and measured with how you respond and make smart and wise financial decisions. So ultimately, what is the difference in having an investment plan and a financial plan, and what are the dramatic differences in that? Are you an investor or are you a speculator? How do you structure things so that moving forward, you don't have to get too concerned or too worried about short-term market volatility, because we know it can and does happen, just as we've seen this week. So I'll have more of that when we come back, as you listen to More Living with Jim Brogan, only on News Talk 98.7 WOKI.
You are listening to More Living with Jim Brogan. During the week, Jim is a financial advisor, an author and speaker with an MBA from the University of Tennessee, who specializes in helping people in or near retirement plan for the next phase of their lives. You can reach Brogan Financial during the week at 865-862-6800 or on the web at broganfinancial.com. And now, here's Senior Market Advisor Magazine's 2011 National Advisor of the Year and host of More Living, Jim Brogan.
This is More Living here on News Talk 98.7 WOKI. I'm your host, Jim Brogan, and we're talking about this crazy volatility in the stock market and what should you be doing about it. How will it maybe affect you in the future, and how can you have a plan to where these kinds of things really don't get you super worried? Where you can be successful. These things can and do happen. I mean, granted, this was an historic week. I mean, it was an historic amount of volatility. As a matter of fact, yesterday, Friday, I don't think I've ever seen a day like that. I mean, at one point, the market was down over 1,000 points again. Now it was down 1,100 points on the Dow Jones Thursday. And then yesterday, at one point, it was down 1,000 points. It was the amount of swings back and forth yesterday. I mean, there were 3 and 4 and 500 point swings several times throughout the day, up and down. And then in the last hour, it went up 600 points. I mean, it was just unbelievable, the types of swings that we saw. All right. And you know what? Before I get to back to my topic here of how do you react to this, I think, and this is really part of it, is how you react to it, is understanding what these point swings mean. Again, with a long-term plan, you shouldn't be focusing on short-term results. You should have a plan. Part of your plan should be how you handle things in the short term, where you have monies that aren't affected. Your short-term monies are not affected by what happened this week. But remember, like I saw the statistic yesterday that the 1,100 point drop, at least what I saw, was the largest single point drop in U.S. history. Well, but that's very misleading, okay? Because an 1,100 point drop on a Dow that was at 27,000 as an example, I mean, that's less than 4%, is a lot less of a drop than when the market would go down 800 points and the Dow was 10,000, that would have been an 8% drop. All right. So, just be, a volatile, movements up to 1% are really not volatile days, and they're not super volatile until they get over 2%. So really, until the market movements at this point are not up over 500 points, it's not, over 250 would be somewhat volatile, but it's not super volatile until it gets over 500. So you need that context because, we're used to those point movements at 10,000 and 12,000 and 15,000. But when the Dow's at 27,000, an 1,100 point movement is just not as substantial. So that's kind of sensationalism. Don't let that scare you too much. Okay? The market was down 11% in the week. For the month, the market was up for part of February before, up to February the 19th. The S&P 500 was up. So, I think for the week or for the month, the market ended up, I don't have the final numbers, the market ended up down probably about 8.5% to 9% for the actual month. Okay. So, but certainly a very, very volatile month. So let's just talk about, what is a financial plan and how is that different than an investment plan? Because so many people with their money just focus on what investments to pick. What is the best investment plan? Is it a mix of mutual funds, ETFs, stocks? Should you use CDs? Should you have an annuity? It's all about what investments you should pick. And that's not what a financial plan is at all. A financial plan is looking very critically at what do you want your money to accomplish for you and when do you want it to accomplish. We have short-term needs. We have midterm needs, and we have long-term needs. And building a financial plan acknowledges that, where we understand how we handle our short-term monies is completely different, radically different than how we handle our long-term needs. There has to be a fundamental understanding of that. So a financial plan deals with all of that, and then it looks at what are the risks that could mitigate my ability to meet my goals with my money. If you're going to retire in 2 years or 1 year, how do you secure income in the early years of retirement where this stock market volatility is not going to affect you? That's what we do for our clients. Our clients really shouldn't be hardly affected by this. Psychologically, it can be unnerving. But our clients aren't depending on this money in the early years of retirement. We've already got that money secured for them where it can be where they're drawing that income from things that are not down right now. One of the real principles of wealth management is don't realize an investment loss. Don't spend. Let me rephrase that. That's really not the right way to say it. The right way to say it is don't spend an investment loss, because it's okay to sell something when it's down and reinvest. Sometimes that's necessary to be strategic and be prudent. But it's not to spend an investment loss. Well, that means that money you need in 2 years for income, or if you're younger and you're saving up to buy a car or a house, or you have an emergency fund and you might need money in the next couple of years, that money shouldn't be invested in the stock market. You might as well just go to Las Vegas and throw craps or play blackjack, because it's just gambling. Now, if you don't need your money for, 10 years, your risk investments, then you're not as affected by this right now this week. Now, you still have to be aware of the cruel math of losses. If you lose a lot, it takes a long time to recover those gains. Those losses, excuse me. So you have to be aware of that. Let me explain what the cruel math of losses is. If you have $100,000 and you lose 50%, you now have $50,000, right? Well, if you have $50,000 and you want to get back to 100,000, to go from 50 to 100, you have to make 100% where you lost 50. That is cruel math. If you lose 33%, you got to make 50 just to get to break even. By the way, the average bear market since 1900, we have them about every 8 or so years, is over a 40% downturn. If you lose 40% of your money, you got to make 67% to get back to break even. If you're 30 years old, you've got plenty of time to go through downturns. But as you get closer to retirement and in retirement, you don't have that type of time. So even if you're focused out 8 or 10 years with your risk investments where you've structured it where your short-term income needs are coming from things that are stable and secure, you still, probably tough to recover from a 35 or 40% loss on your risk money. It might not grow back much in 8 or 10 years. So don't get me wrong, you still need a plan for handling volatility on your risk investments. But the most important thing is the money you need in the near term should not be invested in the stock market. And then money you need in 5, 6 or 7 or 8 years, it shouldn't be aggressively in the market. Because if we have a substantial lasting downturn, lasting bear market, then, it's probably not going to grow any. It may recover, but it won't grow, and you got to worry about inflation. So this, a financial plan is looking at what do you want out of your money and when do you need it? And the when do you need it part is just as important, really. And then having a plan to give you the greatest likelihood of getting there. And then what are the risks to that plan? So there are a lot of things to factor in. I mean, I'm focusing on the investment side, and I've mentioned some about the income plan. How do you fold in Social Security income? Your Social Security election is critical. And if you're going to delay your Social Security, that means if you need income in retirement and you're going to delay your Social Security to get those 8% per year increases to age 70, then, you're going to need more income from your savings. You need more protection of that income in the early years so that this type of market volatility and instability doesn't really affect you in the early years of retirement. All right? So, your Social Security election could come into play in being critically important. There's tax planning, there's estate planning, there's health care. There are many, many facets that have to be addressed in a comprehensive financial plan. So when we come back, I'm going to get into a few more of those. And then I'm also going to say, if you don't already have a plan, and this market volatility, therefore, I agree, it'd be very unnerving because you don't have a plan. How do you go about doing things when we're seeing this kind of volatility? So don't go away. This is More Living with Jim Brogan on News Talk 98.7 WOKI.
His weekly radio show, television news appearances, and adult education classes taught at the University of Tennessee and Pellissippi State Community College, Jim taps into his extensive knowledge and experience to address issues important to living your best retirement. Join Jim every Saturday morning at 9 a.m. here on News Talk 98.7 WOKI and visit him online at BroganFinancial.com. And now, here's the host of More Living, Jim Brogan.
Welcome back to More Living with Jim Brogan, where it's all about living the best years of your life your way. This is News Talk 98.7 WOKI, and part of being able to live the best years of your life your way is being able to be confident in your financial plan when we have weeks in the stock market like we've had the past week. And, with what we do for our clients, we've already protected their short-term income needs. They're not dependent on monies that are in the market in the short term. That's monies for down the road. Now, then we still got to address tremendous diversification and hedging and things, because most of our clients that are retirement age, the money that they have invested in the market, they don't want to lose 40% in a downturn. But that's, and so that's important to be able to measure and assess their risk. But, if you have a question about all this and how this affects your money, feel free to give us a call. I don't take calls a lot on this show, but I'm happy to do it here in studio. 656-8255. That's 656-TALK. 1-800-951-8255 if you're outside the area. But give us a call if you'd like to discuss the market or what's going on or where we may be headed or how it affects your money. I'd be happy to talk to you.
Monday on the Field Show. If you had...
Now, so when it comes to our financial plan, it's investing for an outcome, and then what are the risks that could affect you getting to that outcome? And there are a lot of them. Certainly on the investment side, it's not just when you'll need it, but it's also, have you measured the actual risk that you're taking? And is it reasonable that you're taking an appropriate amount of risk? And that's an important thing to consider, because investing is all about balancing risks and rewards. And on the one hand, you need to take enough risk, because inflation is one of the real powerful opponents of retirement. So you need long-term growth. So you need to take enough risk, but you need to be careful you don't take too much risk. And then you also want to be careful you don't take more risk than you're comfortable with. It's important to assess for you, how much loss are you comfortable with in a bear market? Now, right now, the market's down from its high, I think about 12%. It was down 11 this week. But let's just say roughly 12. I don't have the exact number. A bear market is 20. The average bear market's over 40. So we're a long ways from that. But if it turns into a bear market and it ends up being average, let's say 42% roughly, how much would you be likely to lose? We know we can't predict the future, but we can measure risk. And actually, measuring risk historically is a better predictor of future risk than when we look at actual returns, like what's past returns versus future returns. Measuring risks, there's no foolproof way to do it, but to predict the future, but it does give us more of an understanding of what your risk would be in the future. So it's important to look at all of those kinds of things. And, because one of the big things is that you don't panic and make a bad decision that costs you in the long run. If you, panic and sell, then what happens if the market recovers in the next few weeks? When do you go back in? It just creates a snowball of tough, difficult decisions. And anytime we try to time the market, it's very, very dangerous. And so when we build the financial plan based on when we'll need money and the risks we're comfortable with, and we measure those risks so we don't get big surprises, we're less apt to have panic or have a behavioral mistake. So it's so critically important. Now then, a couple of other threats. One is income taxes. I think it's going to be a challenging decade. The entire decade is going to be challenging to make a robust return. And if you can reduce your tax bill on your returns, which is not only on your investment returns, but how you draw income. You look at tax-efficient ways of drawing income. You look at opportunities of taking advantage of low tax brackets before you're 72 years old and have to start taking IRA and 401k distributions. You look at maybe even a plan to be able to realize long-term capital gains at 0%, which a lot of our clients are able to do, especially in that sweet spot between retirement age and age 72. You can really make hay and make some wise tax decisions. And then your estate planning has to be considered. How are your kids going to pay taxes on your IRAs and 401ks? The new Secure Act was passed right before Christmas. And your kids can't do, when they inherit your IRAs, they can't do what they used to be able to do, where they take distributions over their lifetime. Now they have to take it all over 10 years. If you've named them correctly as beneficiaries. If you haven't named them correctly, they have to take everything maybe over 5 years. So tax planning becomes even more critical for them, which is part of your estate plan. How are you going to be taxed on IRA withdrawals, and then considering how they're going to be taxed? And then there's your health care plan. How are you going to pay for health care? Now, I talked about this actually on the Phil show Thursday, because he asked me about health care costs. And I think the important thing, because you hear these numbers like, the average retiree is going to spend $280,000 on health care. I think that's for a married couple throughout their retirement. Well, we don't pay for that all in one lump sum. According to the Bureau of Labor, we're going to spend about $400,000 on our housing in retirement. But we don't think about that as, how am I going to pay $400,000 for my housing costs? That's kind of silly, right? We don't pay $280,000 for health care all at once in a lump sum. We pay it on an annual basis in our Medicare premiums and our supplement, and with some utilization costs when we go to the doctor and the hospital. So you should build that into it. It's an itemized line on your financial plan in terms of your expenses, that you need income to be able to cover that. The average retiree at 65 years old spends about $5,000 to $6,000 a year on their health care, all in. When you look at Medicare premium, supplements, and utilization. Now, then that's going to go up that's the average that doesn't have a lot of significant, maybe a couple of, maybe you're on blood pressure medicine and high cholesterol. You could have a couple things going on, but you're not in serious health problems. But then as you age, your utilization's going to go up. You're going to have a little bit more cost. It could be $10,000 a year per person when you're in your 80s. So you need a plan to be able to pay for that. So I'm not underestimating the reality of healthcare costs, but it's not a lump sum. It's something you pay every year. Then there's the threat of long-term healthcare. And unfortunately, the problem is if you don't have the resources to pay for long-term health care, because 7 out of 10 people 65 years old are going to need long-term health care. So 70%. It's almost 50% likely a married and husband and wife are both going to need long-term health care. So do you have a plan to be able to provide the resources for that so that your loved one that helps take care of you, that it doesn't change their life forever as well? Because unfortunately, actually oftentimes the healthy spouse ends up dying before the spouse that needs long-term care, because the healthy spouse has to provide for all that care and be the primary caregiver, and it's a huge emotional and physical burden. So again, these are risks to you being able to have success with your money and with your life. And so a financial plan looks at all of that and then acknowledges that there are crazy things that happen, especially in the short term in the stock market. And we address those things before they happen. So our clients right now, we've secured their income in the near term. They're not going to have to pull from this money that's in the market. And their monies that's in the market, as a rule, are not down nearly as much as this U.S. stock market. I'm not saying everybody, because some people are more aggressive. Every plan should be unique for you. But you should be measuring all of that. Now, I will tell you this is all stuff that I teach in my college classes. The University of Tennessee has them, Mississippi State has them, and I'm fortunate enough to be able to teach them. My next one on March the 3rd and 10th is just about full. There might be room for 2 or 3 more people. I know we were almost full as of Thursday. I didn't check the number today, but if you want to find out, go to PellissippiRetirementPlanning.com. You can get more information and download a syllabus, and you can click to register if there is an opening. But if it is full, I'm going to be in Blount County in April, and then at the end of April and into early May, the last week of April and first week of May, I'm going to be at University of Tennessee downtown. And I do 2 2-hour sessions. And I cover 7 major areas of how to create a complete plan that, as much as we can, takes the short-term market volatility out of the equation as much as we possibly can. All right, I would love to see you there. Again, go to just if you want to see the whole schedule, go to broganfinancial.com and click on the link for classes. Again, broganfinancial.com, click on classes. I'd love to see you there. Now, tell you what, when we come back, what if you don't have a plan now and you're very, very nervous about where this is headed with the coronavirus and its effect on the stock market, and yet we've got these 700, 800, sometimes 1,000-point swings daily? How do you react and not make a critical mistake? So stay tuned. I'll talk about that in my final segment as you listen to More Living with Jim Brogan on News Talk 98.7 WOKI.
Thank you for listening to More Living with Jim Brogan. If you miss any of today's show or want to listen to it again, visit BroganFinancial.com, where you can access the podcast and other educational materials to help you in your journey through retirement. And now, here's Senior Market Advisor Magazine's 2011 National Advisor of the Year and host of More Living, Jim Brogan.
Thanks for tuning in this morning to More Living here on News Talk 98.7 WOKIs. We're discussing this week's market volatility, which is short term. Now, we don't know how long it's going to last. Trying to predict it is a fool's errand. We don't know how the coronavirus is going to spread. I do think it's going to get worse. But this is temporary. This is transitory. It is not permanent. So, our investments that are invested for the longer term, which, is our growth-oriented stuff, we gotta be smart about how we handle this. Now, I've been talking today, and I'm sorry, I'm a little bit out of breath. I've run to my car there between the break, and boy, I tell you what, I guess I need to be working out more. What about you, Colin?
Oh, no, yeah, for sure I need to get in the gym.
Oh, gracious. I swim a couple times a week, but obviously I need to do more. But anyway, so I've been talking about a financial plan. Now, what do you do if you haven't really gotten your arms around your planning, and maybe you haven't assessed the risk in your portfolio, and you just don't know, and you're nervous right now? How do you need to be responding to what's going on right now? And I think that's super, super important. And here would be my counsel. I think there are a couple of things. One, I think you need to be very measured and calculated in what you do. And there is a good bit of panic right now in the market. I don't know how long that's going to last. And it can be very dangerous trying to figure things out and doing a lot of trading into the teeth of a lot of volatility. However, I do think you need to work at creating a plan based on where you are now today and where you want to be. And then it's a matter of being smart about how you implement that plan. There's no reason that you can't go ahead and be developing a plan of how you need to structure your money both now and into the future to secure your ability to retire, or if you're already retired, secure your ability to stay retired and be successful and thrive in retirement. There's no reason you shouldn't be going ahead and doing that. And if you're, like I say, if you're not retired, go ahead and start working on the plan. Then the question becomes, how do you implement the plan, and when do you implement the plan, and doing it in a reasonable kind of a way where you don't expose yourself to big mistakes in what has been somewhat of a panicked type of a market. All right? So I think that's the key. So don't put it off. Go ahead and start working on it. A great way to start getting the information for that is the class I'm teaching next week at Pellissippi State, March 3rd and 10th. You can go to PellissippiRetirementPlanning.com. We're almost full, so hopefully we still got room. I didn't check the numbers this morning. We were almost full Thursday, but hopefully there's still room. I'd love to see you there. Again, go to PellissippiRetirementPlanning.com, or you can call Pellissippi at 539-7167. If it is full, I'm in Blount County in early April, and then I'm back at UT downtown at the end of April and early May. For our full schedule, go to BroganFinancial.com, click on classes. Now, you can also follow me online. If you go to BroganFinancial.com, you can sign up for our weekly e-newsletter blast. And I'm going to have a blog coming out early next week about coronavirus and about the markets and what it means for you and me and how we should be reacting to it. But if you just don't know where you stand and you don't know what your risks are, the market's down, like I say, 11, 12%. A bear market is over 40. So go ahead and start working on your plan. Implementation, you got to be smart and measured in how you implement the plan in consideration of what's going on in the market. But you need to be working forward on something like that with some progress, so you can secure your ability to do what you want to do. If you're planning on retiring in a year or two, this past week shouldn't affect your ability to do that. But it could if this turns into a 30 or 40% downturn if you don't look at doing a plan and protecting your ability to retire. All right, or if you are already retired, that you don't figure, it doesn't turn into a situation where you've made a critical mistake and you can't really undo it. We only get one chance to retire. So we got to be careful we don't make a critical mistake. Okay? So those would be my biggest tips in terms of how you need to be handling your money. Just, caution. Be sane, work on developing your plan, and instead of just trying to pick investments, work on how can you structure your money to accomplish your goals and what are the risks to all of those goals. All right. Now, in closing, I just want to layer in here that we're in a presidential election year, and I think the result of that is we have a lot of heightened sensitivity in the markets. And I think that's going to happen throughout the whole year. I don't know where the year's going to end up. At the beginning of the year, I would have said I'd think a modest gain in the markets. With this coronavirus, who knows? Who knows what's going to happen in November in the election? It's certainly a heightened sensitivity right now. Even the reactions to coronavirus are heightened and overly politicized. And I hate it, and I know many of y'all hate it, that they're taking this potential serious medical issue and they're politicizing it. We all hate that. I think most people do. But it's the reality. And then the media sensationalizes it. How much did that contribute to the stock market decline this past week? I don't know that we could ever pinpoint that, but I think it's naive to think it didn't make an impact. Because when people are on TV, sensationalizing things like this, investors are more prone to panic, and that feeds the beast. And the beast is the market turning down the way that it did, because we have this massive selling. So we're in a hypersensitive world. We got an election coming up, and this election could prove to be a very, very pivotal point in our future. Now, you've heard me talk about that politics historically doesn't really have a tremendous effect on the stock market. The markets don't seem to prefer one candidate or one party over another being in office. Not strongly anyway. If anything, what the markets prefer is a divided government, where the party that has the White House doesn't have both arms of Congress. But bottom line is, this may be different. If we end up with a Bernie Sanders versus Donald Trump presidential election, you have a tremendous dichotomy of two candidates on two extremes, capitalism versus socialism. Now, if we have a more moderate candidate like Joe Biden or Michael Bloomberg or whomever, then, it's maybe not as sensationalized of a choice. But the bottom line is we need to make smart decisions based on our money, and we do that by looking at when we're going to need our money. And we understand that our short-term needs don't need to be invested in the stock market. The early years of retirement, we don't need to be drawing income from monies that are invested in the stock market. Monies that are invested for the longer term is where we take risks. We need to measure and calculate the risks that we take so we don't get any surprises, because when we get big surprises, we're prone to make emotional decisions and emotional mistakes and panic. And a lot of investors did that this week. So, stay tuned to my show. Follow me online. You can attend our classes. Go to BroganFinancial.com. Click on classes for more information, and there's just a wealth of information there. But I think, cooler heads will prevail. And in the meantime, let's not lose sight of exactly what we want our money to accomplish. And, if you're one of those that sits in front of the news all day, watching all the sensationalism on Fox or CNN or something like that, when it comes to the reporting of the panic and the fear, just be careful that doesn't overly feed into what you're thinking with your money and what you do with your money. Because when you watch media, they're trying to attract viewership. And the more they can sensationalize the message, the more viewership they're likely to receive. And then they have more viewers, and then they can make more money, and people pay more for ads because they have more viewers. So just try to watch things with a little bit of a filter. And in the long term, understand that short-term volatility and a good financial plan should not affect your long-term plan, because you've structured your short-term needs with monies that are not invested in the stock market. Thank you for tuning in this week. We've discussed your wealth, because greater wealth provides for more living, so you can live the best years of your life your way. This is More Living with Jim Brogan on News Talk 98.7 WOKI.
The views expressed by Jim Brogan and his guests are not that of Cumulus Media. Any discussion of financial, legal, and tax planning strategies is not intended to be individualized advice and is general in nature. Always consult with your advisor for advice specific to your needs. This program's content does not represent a recommendation of any particular security, strategy, or investment by Jim Brogan or Brogan Financial Incorporated.